Let me ask you something. Do you control your credit card, or does it control you? Because here's the uncomfortable truth. Credit cards are one of the most brilliant financial tools ever invented. But for most Americans, they're not tools. They're traps. By the end of this video, you'll understand exactly how credit card companies profit from your psychology, why most people never escape the cycle, and how the wealthy flip the game entirely and use credit as leverage instead of a leash. This isn't about cutting up your cards. It's about beating the system at its own game. Part 1. The illusion of plastic freedom. Let's start with how you got here. You're 18, maybe 21. You get your first credit card offer in the mail. They're giving you $2,000, $5,000, maybe even $10,000 in buying power. It feels like free money. It feels like adulthood. It feels like freedom. So you swipe. A dinner here, a flight there, new shoes, a laptop you've been wanting. And for a few weeks, maybe even months, it feels amazing. You're living better than your paycheck allows. You're keeping up with everyone around you. You feel like you've unlocked a cheat code. But then the bill comes, and it's bigger than you expected. So you pay the minimum. After all, that's the option they give you. Just $35 this month. That's manageable, right? You'll pay it off next month when things calm down. Except next month, you swipe again, and the balance grows. And now you're not just paying for what you bought, you're paying interest on money you already spent. And that's the trap. That's the moment you stop being a customer and become a profit center. Because here's what they don't tell you up front. Credit card companies don't make money when you pay in full. They make money when you carry a balance. They make money when you pay late. They make money when you only pay the minimum. In fact, the credit card industry made over $120 billion in interest and fees in 2023 alone. That's not coming from people who pay off their cards every month. That's coming from people stuck in the cycle. And the system is designed to keep you there. Part 2. The hidden interest trap. How the math destroys you. Let's talk about the numbers no one explains clearly. You've got a $5,000 balance on your credit card. The APR is 22%. Pretty standard in America today. You decide to only pay the minimum each month, which is usually around 2% of the balance, so about $100. Here's the question. How long will it take to pay off that $5,000? Most people guess a couple years. Maybe 3. The real answer? Over 30 years. And you won't just pay back $5,000. You'll pay over $13,000 in total. Let that sink in. A $5,000 purchase ends up costing you $13,000. Why? Because of compound interest working against you. Every month, you're charged interest on your remaining balance. But since you're only paying the minimum, most of your payment goes toward interest, not the actual debt. So the principal barely moves. You're running on a treadmill, exhausted and going nowhere. And here's the truly evil part. Credit card companies structure the minimum payment precisely to keep you in debt as long as possible. If they wanted you to pay it off, they'd require higher minimums. But they don't. Because the longer you're in debt, the more they make. And it gets worse. Let's say you miss a payment, or you're late. Your interest rate can jump, sometimes to 29.99% under penalty APR clauses buried in the fine print. Now that same $5,000 debt explodes even faster. Add in late fees, $25 to $40 every time you're late. Over-limit fees if you max out your card. And suddenly your $5,000 debt isn't just costing you interest. It's costing you fees on top of interest on top of more fees. This is how people get trapped. They think they're managing it. They think they're staying afloat. But mathematically, they're drowning, slowly and invisibly. And the banks? They're counting on it. Their business model depends on you staying in debt but never defaulting. That's the sweet spot. You keep paying, they keep profiting, and the cycle never ends. Part 3. The reward psychology. Credit card companies have spent billions studying human psychology. They know exactly how to manipulate your behavior. And rewards programs are their masterpiece. You get 2% cash back on groceries, 3% on gas, 5% on dining. You rack up points for flights, hotels, gift cards. Every swipe feels like winning. Every statement feels like you're getting paid to spend. But here's the trick. Rewards are designed to make you spend more than you would otherwise. Studies show that people using credit cards spend 12 to 18% more than people using cash. Why? Because plastic doesn't feel like real money. There's no psychological pain. You're not watching bills leave your hand. You're just tapping a card and moving on. And those rewards? You're not actually winning. You're spending $5,000 to get $100 back. That's not a deal. That's a distraction. The real profit isn't in the rewards you earn. It's in the interest you pay. If you carry a balance, that 2% cash back is instantly wiped out by the 22% interest you're being charged. You're losing $1,100 a year to gain $100 in rewards. But it doesn't feel that way, does it? It feels like you're being smart, like you're gaming the system. That's intentional. They want you to focus on the rewards, not the interest. They want you to swipe more, justify more, spend more, because every additional swipe increases the chance you'll carry a balance. And once you carry a balance, they've got you. And then there's the credit limit game. You start with a $2,000 limit. You use it responsibly for 6 months, and boom, they raise it to $5,000. A year later, it's $10,000. Another year, it's $15,000. They call it a reward for good behavior. But it's not. It's bait. Because now you have access to more money than you need. And when life happens, car breaks down, medical bill, emergency expense, you don't save up. You swipe. Because the credit is there. Because it's easy. Because it feels like your money. But it's not your money. It's their trap. And the bigger your limit, the deeper you can fall. Part 4. The debt cycle. Why most people never escape. Here's where it all comes together. Most Americans aren't carrying one credit card balance. They're carrying 3, 4, sometimes 10. The average American household with credit card debt owes over $17,000 across multiple cards. And here's what happens. You're trying to pay off card A, but life happens. Your kid needs school supplies. Your car needs new tires. So you put it on card B. Now you're paying minimums on 2 cards. Then you get an offer for a new card with 0% interest for 12 months. Perfect, you think. I'll transfer the balance and pay it off interest-free. So you do a balance transfer. But here's what they don't emphasize. There's a 3 to 5% transfer fee up front. So your $5,000 balance just costs you another $250 before you even start. And that 0% interest, it's only for 12 months. After that, it jumps to 24.99%. And if you miss one payment during that promotional period, the rate kicks in immediately and applies retroactively. So now you're back where you started, except with another card, another balance, and another payment to juggle. This is the debt cycle. You're not paying off debt. You're moving it around. You're treading water, exhausted, but never actually getting to shore. And the banks love this, because the more cards you have, the more interest they collect. The more payments you miss, the more fees they charge. And the more overwhelmed you feel, the less likely you are to pay attention to the math. Meanwhile, your credit score tanks. Because high utilization, using a large percentage of your available credit, destroys your score. So now you can't get a loan for a house. You can't get a lower interest rate on a car. You're locked into higher rates for everything because your credit is wrecked. And all of this started with one swipe. One minimum payment. One, I'll pay it off next month, that turned into 10 years of payments. This is how credit cards keep you poor. Not by stealing your money outright, but by keeping you so busy managing debt that you never build wealth. Part 5. How to beat the system, using credit as leverage. Okay, now here's the part where we flip the script. Because credit cards aren't evil. They're neutral. It's how you use them that determines whether they're a trap or a tool. Rich people use credit cards all the time, but they use them completely differently than everyone else. And once you understand the strategy, you can do the same. Rule 1. Never carry a balance. Ever. This is non-negotiable. If you can't pay it off in full at the end of the month, you can't afford it. Period. Rich people use credit cards for convenience and rewards, not for loans. They swipe knowing the money is already in their account. They treat credit like a delayed debit card. The moment you carry a balance, you lose. The interest erases any benefit. So if you're currently carrying a balance, your first mission is to kill it. Snowball method, avalanche method, whatever works. But kill it. Rule 2. Automate full payments. Set up autopay to pay the full statement balance every month, not the minimum. The full balance. This does 2 things. It eliminates the temptation to pay less, and it ensures you never pay a cent in interest. You're using their money for 30 days interest-free, then paying it back before they can charge you. That's leverage. You're borrowing their money, using it, and returning it without cost. Meanwhile, your cash sits in a high-yield savings account earning interest. You're literally making money off their system. Rule 3. Use rewards strategically, but only if you're disciplined. If you're paying off your card in full every month, rewards are free money. A 2% cashback card on $3,000 in monthly expenses is $60 a month. $720 a year, but only if you're not spending more because of the card. Track your spending. If your expenses go up after getting a rewards card, the rewards are costing you money, not making you money. And never, ever justify a purchase because of rewards. That's their trap. Buy what you need. Get rewarded for it. Don't buy because of the reward. Rule 4. Build credit intentionally. Here's something most people don't know. Having credit cards and using them responsibly is one of the fastest ways to build a strong credit score. The key is utilization. You want to use less than 10% of your available credit at any time. If your limit is $10,000, keep your balance under $1,000 and pay it off in full every month. This tells lenders you're responsible, you have access to credit, and you don't need it. That builds your score fast. A high credit score unlocks everything. Lower mortgage rates, better car loans, higher limits at lower interest. That's leverage. You're using the system to position yourself for bigger opportunities. Rule 5. Use 0-cent offers correctly, but carefully. If you have a big purchase coming, let's say you need a $2,000 laptop for your business, and you have a card offering 0 interest for 15 months, you can use that strategically. Buy the laptop. Divide $2,000 by 15 months. That's $134 a month. Set up automatic payments for that amount. You've just financed your purchase at 0% interest while keeping your cash liquid for emergencies or investments. But here's the rule. You must pay it off before the promotional period ends. Reminders. Treat it like a loan with a deadline. Miss that deadline and you're hit with retroactive interest on the full amount. This is how the wealthy use credit cards. As short-term, interest-free financing tools. Not as long-term debt. Rule 6. Know the fine print. Annual fees, foreign transaction fees, balance transfer fees, cash advance fees, read everything. If a card has a $95 annual fee, make sure you're getting more than $95 in value. Otherwise, you're paying them to use their card. And never, ever take a cash advance on a credit card. The fees are brutal, often 5% upfront plus interest, that starts accruing immediately at 25% or higher. It's one of the worst financial moves you can make. Part 6. The mindset shift. From trap to tool. Here's the ultimate truth. Credit cards are designed to exploit weak financial discipline. But if you have strong discipline, they become one of the most powerful tools in your financial arsenal. The difference between being trapped and being empowered is simple. Do you control the card, or does it control you? Average people see a credit limit as spending money. Rich people see it as a safety net they never touch. Average people swipe first, worry later. Rich people plan first, swipe strategically. Average people chase rewards and pay interest. Rich people earn rewards and pay nothing. The system isn't rigged against you. It's designed to exploit human psychology. But once you understand the game, you can play it better than 90% of people. And when you do, credit cards stop being a burden and start being a weapon. You build credit. You earn rewards. You access capital when you need it. You leverage 0 offers. You protect purchases with fraud protection and extended warranties. You track spending automatically. You maximize cash flow. All of this, without paying a single dollar in interest. That's how you beat the system. Not by avoiding credit cards, but by mastering them. Credit cards keep most people poor because they exploit behavior. But now you know the traps. Now you pay in full. Automate everything. Use rewards without changing behavior. Build credit intentionally. And never, ever let plastic convince you that debt is normal. This is real-world finance, where we teach you to beat the system, not get beaten by it. If this video just saved you thousands in interest, hit that like button and subscribe, because we're exposing every financial trap designed to keep you broke.